Hello everyone. We are back with an update on economy and market for the month of August 2021. Equity market continued to rise across the globe. So it has paid off being invested in equities. India was an outperformer and the rally was broad-based with a relatively sharper rally down the capitalization curve. FIIs have favored Indian equities in 2020 and year to date, though the quantum of flows have moderated in the recent months. In fact, retail participation by the domestic retail investors have been particularly strong, both through the MF route and through the direct retail participation as well. Retail investors have skewed their investment towards the small and mid cap stocks or small and mid cap funds as well, explaining the outperformance. Globally, COVID cases has continued to rise and has weighed down on the activities in the countries where vaccination penetration is low. Thus, COVID continues to have some bearing on the activities as well as some bearing on the supply chain disruption as well, such as chip shortages, and it is also leading to higher supplier delivery time and higher logistic cost. Countries which have better vaccine penetration have seen lower fatalities. But there has been growing acceptance that perhaps a booster dose is needed beyond the second dose as well. Within India, while the cases have come off sharply and vaccination is progressing fast, one needs to watch out for the coming festive months where social gatherings may increase and so the cases may increase too. As a healthy development, 50% of the adult population has received first dose and 15% has received both the dose. And vaccination is progressing fast. On an aggregate basis, activity and mobility appears to be back to pre-COVID level, though recreation-related mobility and rail and air travel is still significantly below the pre-COVID levels. And as the recovery continues, the external demand for goods and services is perhaps the strongest. Infrastructure activities are faring well. Manufacturing is doing better than the services, and business confidence is more optimistic than the consumer sentiment. Employment has shown an encouraging trend in July. IT sector and electronic sector are showing strong hiring, and so the government tax collection is also progressing well. In fact, owing to the strong IT exports, the net foreign receipts from services coupled with the FDI inflow has been more than sufficient to fund the trade deficit of goods in India. Overall, on the external account, it is fairly robust, unlike the 2013 situation when the US Fed had indicated its tapering program back then. The rollout of this rupees 6 trillion national monetization program in August indicates that government is willing to go beyond the conventional routes and address all the funding constraints to keep the infrastructure activity going. In fact, recent earnings commentary has indicated on the timely payments on the government orders. We will watch out for the potential third wave and the likely impact of that on the economic activity. But broadly, the economy is poised for recovery, favored by easy liquidity and financial conditions, government push to infrastructure, continued global demands for both goods and services, and bottoming out of adverse job situation, and a healthy corporate and a financial sector balance sheet in India. We also had a close to quarter 1 FY22 earnings outcome, and it depicted a healthy profit. It was in fact quite interesting in FY21 that despite the economic contraction, your profit grew in FY21. It was made possible by cost rationalization. Businesses had leaner balance sheet, inventories were reduced, and working capital needs were reduced by bringing down the credit lines. In fact, until December 2020, business did not face a material rise in raw material cost too. And in fact, they had curtailed on the employee cost as well for the aggregate industry. Now, some of these factors like raw material cost, employee cost, and in fact the working capital requirements may reverse in FY22. If you expect the rise in demand, businesses will have to build on the inventory, in fact, at an elevated input cost. These are some of the negative aspects, but at the same time, sales is in fact expected to recover from a very depressed base of last 2 years. It is also being gathered from various surveys that despite volume concerns, more and more businesses are now willing to take on the price hike to pass on the rise in input cost. Finally, last year, when the profit was good, business had taken on this opportunity to deleverage and bring down their interest cost. This reduced interest expense will pay off in the profit even in FY22. So overall, we expect profit to stay healthy even in FY22 and couple of years down the line. And that is why, even as valuations appear expensive on the conventional matrix, it is broadly neutral for the large cap if you adjust it for the earnings yield minus the bond yield. Until a couple of months ago, we were talking about a broad based rally. The small and mid cap stocks appear to be relatively cheaper compared to the large cap. But given the recent moves, the risk reward is more in the balance now. And going ahead, hence, instead of more top down, we think it pays off to stay invested in stocks or sectors which have a better earnings visibility. Coming to the fixed income market, even as the cases and hospitalization rose in US during the last month, US Fed during its latest Jackson Hole symposium did not indicate a material concern beyond the near-term impact. In fact, they reiterated a likely start of tapering late this year. But interestingly, despite this Fed commentary, US Treasury has been particularly contained in July and August. It is partly explained by the technical factors of demand and supply as well, and we expect that US Treasury may gradually rise in the later part of this year, with growth cooling off in China, impact of Delta variant, and the recent Fed commentaries. Commodities have softened a tad bit in August, but they are still elevated compared to a year ago. EM currencies rallied in the August month, and India was a relative outperformer. Despite the recent appreciation, we expect rupee to be on a marginal depreciation bias through the year, as we expect dollar to strengthen through the year. Indian rates have been volatile. In fact, the volatility on rates and currency has been something that we have been highlighting for last couple of months. GSEC-E across the tenor rose in the first half of the month, but they have rallied by some 10 to 12 basis points during the last 10 days of the month. CPI inflation came in at 5.6% in July, after 6.3% in the May and the June month. In the near term, we may have attained some peak on CPI inflation and it may cool off in the recent months. But overall, we expect inflation both for 2021 and 2022 to stay relatively elevated compared to pre-COVID levels of 3 to 4%. And that is because the last couple of years prior to COVID was the era of soft commodity prices. Now the commodity prices are rising, businesses are talking of taking price hikes, transportation cost is elevated because government hasn't cut down on excise duty despite the elevated crude prices. So for all these reasons, we see pressure on the core side of CPI and hence inflation to be a bit higher than what it was in the pre-COVID level. Government taxes are held and government has been cautious to spend. Overall, both center and state government finances will fare well. It appears so for FY22. And so far, in fact, the borrowings have been marginally lower than what was indicated by the calendar. We do not expect any material negative supply on the government bond for FY22. But like we have always said, the deficit which rose for the government post COVID will take some years to adjust back to the pre COVID level. And as such, the market supply of government securities will stay elevated for next couple of years down the line. Now, The August monetary policy was broadly on the expected lines, though there was one dissenting member on the accommodative stance. And the minute indicated that the talks or discussion on the normalization has begun. There was an announcement for increasing the quantum of BRRR, and that has been used. But even as RBI has been sucking out liquidity through BRRR, it has been injecting permanent liquidity through GSAP and FX purchases. So much so that the net banking system liquidity continues to see accretion even after this RBI announcement. As the economy recovers, and COVID has less of a bearing in the economic activity, the discussion and likely action on policy normalization will gather steam, perhaps by the end of the year or an early start of the next year. RBI is an inflation targeting bank. It cannot ignore the negative rates and massive liquidity pulled off. And as policy normalizes, there could be an upward move across the yield curve. As such, it pays to stay cautious on fixed income from an overall perspective, though there could be some tactical gains across the tenor of the curve. Thanks. This is an update for this month. Wishing you a healthy life, taking your leave until we catch up again next month.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.